pretty stellar week, that 21,900 mark that we managed to deliver in the week gone by and sustained around that level. So it wasn't a big slip. But the question is, Nikunj, do you think it's getting a bit more over-enthused right now? I mean, we were talking about the kind of run-up that we have seen in the month of November, December. Where do we, go from here on?
See, let's understand what has happened in last 2 days. What has happened in last 2 days is that Nifty's got a real push, and Reliance has chipped in very smartly. And IT stocks, in a sense, there is a case for short covering. I won't use the word earnings re-rating, but there is a case for short covering. So large cap stocks were bereft of a trigger. They needed some hand-holding coming from in sector, and they needed a leadership sector. Has the tide turned for Reliance? One. And are the quarterly numbers good enough for IT now to move it from is yet to come, but the contraction in the business is totally over. Now that's a very powerful narrative for the IT sector per se to happen. And then for Reliance, which in a sense has been a sleepy stock. So the combination of short covering in IT and leadership in Reliance is a very potent combination. Can it really take markets to a new high, which it already has done? So that I think really seems to be the setup on the table. This week, the real test would be more numbers. And then as we move into companies like capital goods, defense, PSUs, that's where a lot of market expectations and assumptions would be tested, because Touch would be off to a great start in terms of earnings so far because of IT and the kind of communication we've got in sense from others also.
Oh, well, yes, but you know what, for IT earnings, of course, the reactions on the stocks are a lot more exaggerated. But if it was a normal kind of environment, I would have suggested that these stocks would have moved anywhere between 2 to 4%. But it's just the market mood, which is right now very firmly tilted towards IT. Given the ownership that we had seen, the consensus was towards a neutral or a sell rating. So there was that room available. But talking about the earnings a bit more, Wipro ADR was up 18%, and that because the company reported a solid set of performance. As far as the Q3 numbers are concerned, the decline was limited to around 2% when it comes to constant currency. The street was expecting that there could be a decline of as much as 3%. So the positive being that it wasn't as bad as the street feared. There was resilience on the margin front as well, and overall the deal pipeline was healthy. The management commentary also pointed out to the fact that we are close to the bottom. For HCL Tech, it was a big beat on the top line itself, a 6% growth coming in on a quarter-on-quarter basis when rest of the IT companies have been reporting a decline. But do remember, for HCL Tech, there was an acquisition that scaled up. There was a large deal, Verizon, that scaled up. And of course, this is seasonally the strongest quarter for HCL Tech, and that's why that performance. But very strong margin show at close to around 19%. They've trimmed their guidance a bit, both the upper end as well as the lower end. But that's par for the course, given the fact that we are towards the end of the year and the managements have a lot more visibility in terms of what is expected for the rest of the year as well. So commentary-wise, yes, positive, but important to mark that they have said that discretionary spend still hasn't picked up. So that's something that you need to take cognizance if those stocks do rally 10 to 15% as the ADR move suggested. In fact, let me listen into what the managements of HCL Tech and Wipro had to say regarding the outlook and the situation on the ground right now.
Discretionary spending has really not picked up. It remains at similar levels like what we saw in the previous quarter. But however, having said that, there are always some bright spots where the spend is resilient, like cybersecurity is an area, SAP migration is an area, data. Now, a lot of customers are embarking on GenAI programs to transform and evolve their data landscapes. So that is again a big opportunity area, and we see some opportunities in that space. So while the overall discretionary spend environment would be similar, there are some pockets where we believe there is strength, and we are focusing on that. And then the biggest opportunity continues to be hyper-automation, delivering hyper-automation, efficiency, productivity benefits to clients. And that's a big theme which is continuing to play out in vendor consolidation and cost takeout opportunities.
You know, there is typically January and February are very important in these industries for, you know, getting a feel for how the industry or how the market will, you know, turn, you know, in the calendar year. I'm starting to have discussions to know how the budgets are from our clients. And, you know, I'll get a better view, but it's a possibility. Let's put it that way. We're not seeing the levels of, you know, slowdown that we were seeing in the past, right? So again, with caution, I'd say that that probably the worst is more behind than ahead.
You know, every quarter has its puts and takes. If you look at Q4, we're still not back to growth. Our guidance is negative 1.5% to a positive 0.5%. It is an improving revenue environment. Secondly, we will have 2 incremental months of salary increases that we will have to absorb. But that said, we've taken several initiatives, and some of that will continue to give us benefits in.
All right, there you have it. That's a word coming in from the managements of the IT companies. But just let's quickly summarize how the global markets as well wrapped up. The earnings have been underway. A lot of the big banks posted downbeat results. Do remember that the markets will be closed today on account of the Martin Luther King holiday. The Asian markets, well, Chinese markets have pared their earlier losses, and for the most part, we'll be watching out for China's GDP print, but it looks like it's a mixed print. Barring Kospi, though, all the Asian markets are holding out in the green. And lots to monitor as well when it comes to events back home. We'll be looking out, of course, for a lot of numbers this week. Heavyweights, the likes of HDFC Bank, Asian Paints, Indocent, HUL, Ultratech Cement. You've got Davos, which begins today. The WPI data and print will be coming off, and then the Tata Coffee as well spinning off, and the amalgamation. So it certainly is a busy week, Nikunj.
No, earnings will start, you know, Awan, and earnings in a sense, especially you will hear, let's say, from HDFC Bank. Very important. You've already got a sense in terms of where the banks are moving. You got to hear again from HUL and Asian Paints. Both are an indication of how the festival season has gone for Asian Paints, because the November was captured for Asian Paints in the last quarter. The Diwali was captured. And then you will hear from even HUL in terms of where the rural recovery is moving. So it's an important week largely from a market construct standpoint. See, market needed something fresh and new. And markets have got that fresh move from Reliance, and they've got a bout of short covering from IT. So frankly, if you look at the market in terms of positioning, will the leadership in Reliance continue, and will the short covering in IT go beyond like today? Because I don't think the numbers are so strong that the short positioning will become long positioning. Brokerages are unlikely to upgrade their targets extensively for IT per se. But yes, market needed a trigger, and it has got one, largely because of what's happened in terms of the positioning of IT and now a squaring up of those positions.